Welcome to What's the Risk, hosted by myself, Daniel Crowe, and Peter Mansell from Mansell Financial Group. This is part 2 of our chat with Bhanu Singh, CEO of Dimensional Australia, where we talked about passive, active management and the flexibility of Dimensional's approach.
For regulatory reasons, your ETFs are tagged as active, and some investors may find that alarming. Are there any sort of reasons why investors shouldn't be alarmed at hearing the term active in relation to DFA?
I think a lot of these terms are quite difficult to define, first of all, and it causes a lot of confusion. So perhaps we can discuss what active means, and we can go from there. There's two definitions of active. One, in my opinion, one is that you don't hold the market. You look different than the market. So by this, I mean a cap weighted, let's stick to Australia, something like the top stock down to $50 million in market cap. There's various ways you can define that in terms of, whether you kick out some particular stocks because they don't really provide Australian exposure or not. And we'll get into some of what indices do in that area, and they're considered quote unquote passive, but they make a lot of active decisions when they're deciding what's Australian equities and what's not. But let's say if the market is defined as broad set of Australian equities, then anytime you look different than that market, you're active, right? So you decide not to buy CBA for whatever reason, or you decide to overweight JB Hi-Fi, you're active. That's an active decision you're making. Why you're making that decision is interesting, right? It could be for something simple as, I'm a CBA executive, I have a lot of CBA stock, I don't want it in my portfolio because I already have a lot of exposure to it, therefore exclude it from my portfolio. Perfectly legitimate reason to do it. For asset allocation reasons, you might have a view on expected returns of a particular stock, and therefore you want to overweight or underweight it. But at the end of the day, that's an active decision you're making. Right? So to me, any portfolio that's not the quote-unquote market portfolio is active. So then the question becomes, what determines that change? What determines that deviation from the market portfolio? The traditional stock picking model is, let's ignore the market prices. We know better than the market. We have a better price for that particular stock. And based on that, we're going to overweight, underweight, exclude, include certain stocks or sectors or countries or whatever you want to call it. I think that's what people think when they think active. Somebody's standing there going, I know a better price for NAB, and therefore I'm going to overweight, underweight it, right? Now, if you're sticking with the first definition, is that you're just looking different than the market, then you could look different than the market even while trusting market prices. Right? So that's what we do. My definition of passive is that you trust market prices. You think market prices have information, that they are predictions of the future because they're forward-looking. When they move, they reflect expectations about what the market is looking into the future, and so they give you a lot of information about expected returns. And you can use that information to build better portfolios. To me, trusting market prices is the best definition of being passive. Right? So the outcome could be that you have a core portfolio which significantly underweights mega cap growth stocks because they're lower expected return based on all the research we've done, and overweights small value stocks because of the research shows us that they're higher expected returns. That's a very active decision because you're deciding to look different than the market, but is driven based on market prices, which to me is a trust in market prices and definition of passive in that sense. Now, that's going to confuse a lot of people, and that's why I try not to get into this whole active versus passive debate. So the way we think about it is we deviate from the market because we think we have information about expected returns. We think there are certain stocks and bonds which will do better than holding the broad market, and therefore we structure portfolios to put more weight in those stocks so we can build portfolios that on expected basis will outperform the market. That's a very active thing to do. But once again, it's based on a systematic, rules-based process which relies on market prices, right? So anytime, and I'll add another one, which is a bit of a pet peeve of mine at the moment, where there's this perception that index equals passive, right? Just because it's an index structure, it might mean passive. Now, what if I told you that index fund was buying only the top 20 tech stocks in the world? That is a very active decision implemented in an index structure, which doesn't make it passive. That's a very active portfolio, just implemented in an index form. So there's this misperception sometimes with investors, particularly sort of the unadvised retail investors, that anything index must be safe, must be passive, but which is certainly not the case when you look at them a bit more closely.
So, Bhanu, there's been a much greater acceptance in the recent years, and I've seen many, that markets do work, and that's reflected in a huge take-up of index investing around the globe. But Dimensional has a tagline of beyond indexing, which I think is quite reasonable personally. Yes, it's a marketing term, but DFA takes a very methodical approach to that issue. So what is beyond indexing in your mind?
Right. Thank you for the question. It's a good question, and you're right. There has been a lot of movement towards passive index type allocations. Once again, I think not all indices are the same. So given that, but let's say movement towards something like an S&P 500 fund or an ASX 200, 300 type strategies, we've seen a lot of money flow that way. And I'll share a story of something that I once saw Myron Scholes present at a conference. This is, I'm going to date myself, about 10 years ago. He was presenting this idea of trust and trust in your investment manager or an asset manager. And idea is like the more you trust them, the more tracking error you're willing to give them. So what does that mean? If you think your fund manager is just never going to miss, is supremely reliable, great at doing what they do, you will let them run whatever they want to run, right? So this would be an extreme example of somebody running a 10-stock portfolio. You pay them high fees because you have absolute trust and conviction that they're going to beat the market. I think over the last 30-ish years, probably 40-ish years, where you've seen a lot of movement towards passive, you've seen, I think what's driving it is the poor performance of the traditional active funds. So you look at things like SPIVA, you look at our own work on the mutual fund landscape, you find over and over every year that active managers continuously underperform the broad market. And they remain, it's very difficult, even before fees and after fees, it's certainly the case, that you just don't see any active managers beat the market on a consistent basis over and over again. So investors have lost trust. And when you lose trust, going back to Scholes' framework, you take all tracking error away. You basically go to the other extreme where it says zero tracking error, give me an index, and you just hug the index, so my monitoring cost is really, really low. Because I don't trust you. So I don't want to monitor you. So if all I want to know is what did the index do and what did you do, it's a very simple way to monitor you. And I think a lot of the movement towards passive is driven by that sort of, lack of trust in the traditional sort of stock picking model. Now, in my opinion, that's not a bad thing overall. You're moving away from perhaps a highly concentrated strategy to a more diversified strategy, lower cost strategy. But I think that's probably where what we do differs from broad indices. Indices are also rule-based, but I think our rules, we would argue, are much better built, more dynamic, more sort of looking at, more robust, and more looking at the frictions of everyday asset management. And I'll get into that a little bit more. But the idea here is that while you're moving away to indices, you're creating a lot of friction and rigidity in how you're investing money. For example, indices don't rebalance every day. They reconstitute a few times a year. On one side is something like Russell indices in the US that reconstitute once a year. At best, you will see something like a quarterly rebalance. What that means is if you're trading your portfolio 4 times a year, typically the market knows well ahead of that date what you're going to buy, what you're going to sell. So you're broadcasting very broadly to the market where you're buying and selling on a particular day at a particular time, and typically at the close of that day, right? So we see huge movement in prices on index reconstitution dates. So in Australia, for example, some of the data we looked at, the pressure on stocks that are being removed or added to an index in 20 days leading up to reconstitution date can be up to 8% movement. Excess returns. So stocks that are being added move up 8% leading up to reconstitution date on average, or stocks that are being dropped will drop 8% leading up to reconstitution date. So you can imagine an index manager, you need to buy a particular stock, you're seeing it climb up 20 days leading to the reconstitution date, and you can't do anything about it. Because the whole market knows that you're going to buy it on the reconstitution day, typically in the last 5 minutes or at the close. So they're buying ahead of you, and on that day of reconstitution, you pay that extra cost, and we typically see that 8% come off to about 2% after reconstitution day, right? And we see this in global data as well. During COVID, we saw things like, it was a pretty volatile time, obviously, but we saw movements around 10% on individual stocks between the market close and the closing auction, which is a 10-minute period. No news, no nothing. It's just the pressure of trading in the close and trying to hug the index on that day. So that's a that's the opposite of introducing flexibility in your investment process. That's rigidity at its extreme. You're telling the market exactly what you're going to trade at what time, and the market has no compulsions around just coming in and saying, no regrets around coming in and taking the other side of that and fleecing you. And that happens all the time. We see it happening that's just one of the problems with indices. So I think it's just in that spectrum of maintaining flexibility, giving trust, giving tracking area to the manager. There's been a reaction to the extreme other end saying, I don't want to have any monitoring costs, just show me the index and show me what your return to the index is minus the fees. Oh, and by the way, you're just tracking an index, so your fees are nothing. So that focus on expense ratio and means that you're leaving money in other places like the reconstitution costs, or for example FX trading, which might happen at the end of the day while you're rebalancing the index, and how that happens. So in our opinion, as a practical fund manager with a lot of experience in implementation, when we look at that and we just say, what's the point? Why would we introduce that level of rigidity into our process? While we might agree with indices on having a rules-based process, we think it should be daily implemented. Prices change every day. There's new information every single day. So why wouldn't we take advantage of the information and trade when it makes sense, rather than broadcast to the whole market that we'll be trading on the last day of June every year? So in our view, it's gone to the other extreme, and there's a better way to go beyond indexing and actually keep in mind some of these common sense things which will add value to the portfolio at the end of the day.
It kind of highlights that point you were making, that you have an issue with indexing is passive or passive is indexing. And we've kind of touched on the idea of active choices by indexes, and we found stuff where there's differences between emerging markets. And so if you went to an infrastructure fund or something like that, there's minimum revenue thresholds there for the infrastructure categories. You need to be 60% from that. And you look at that and there's, well, that's quite an active choice. That's quite a niche example, you might think. But then you go and find stuff in the S&P 500 where it's taken like quite an amount of time for a stock to find its way into the S&P 500, despite the fact that it was in the 500 largest companies maybe a year or more ago.
Yeah. I think we did this study on the number of companies, and I think the extreme example of this is Tesla. Was the 6th largest stock in America when it was added to S&P 500. 6th. So not anywhere near 500 by the time it was added. And then there's this obscure committee that decides when to add stocks and which stocks make it and which don't. And the average time period between a stock crossing the 500 mark and being added to the index is well over 12 months, and often the return you leave on the table because of that is humongous, right? I don't have the exact number on top of my head, but it is a meaningful difference between buying it when it becomes a large cap versus buying it when an index thinks it's a large cap or is added to the index. Once again, it's rules based, but some of these rules just are unnecessarily rigid and doesn't make any sense. So how much money are you leaving on the table because you're not buying the likes of Tesla when they become 500 versus buying them when they're 6th largest? You can imagine going from 500 to 6th largest would have been a hell of a run for that stock in that time period. And there's plenty of examples like these. And then other even more sort of what you might think of as just pretty straightforward, like, wait a minute, this doesn't make any sense. For example, there's this idea of using free float adjustment. So what do I mean by that? Typically, take an example of a company where the founder still holds half of the stock in the company, 50% of it, you would argue that 50% that the founder holds is not really available for investment to other investors. So therefore, the free float adjusted market cap of that stock should be half of its traditional total market cap. Now that's a very useful thing in figuring out how to weight stocks. So while I think the company might be a $10 billion company and therefore it's a large cap company because it's a $10 billion company, which is typically above the minimum threshold for being a large cap, but let's go to the extreme, call it a $20 billion company. But let's say its float is 50%, and therefore what's available for you to invest in is 10 billion, and therefore you will weight it in your portfolio based on what's available for you to invest, which is 10 billion. But whether you classify it as a large cap or a small cap should have nothing to do with the free float, because it's a $20 billion company. Half of it just happens to be held by the owner, which has nothing to do with the size. But small ords and ASX indices, for example, in Australia, will use free float adjustment as a determinant of whether a company is large or small. So the funny example that comes out of that is if you look at the Small Ords Index, which is a small cap index in Australia, it holds News Corp. which is a $25 billion company. Because the free float on that company is small, and if you use free float as the line for size small versus large, you end up with News Corp in a small cap index. Unibail, Westfield is a French company, Alcoa, forgetting the fourth one I had, Auckland International Airport. They're all 4 large cap companies, but they make up around 2.5% of ASX Small Ords, right? And you could argue on top of that, none of them are Australian companies, but they're part of Australian indices because they have one class listed in Australia. A2 Milk is another example, Singapore Telecom is another example. So you're kind of doubling up on these companies. You're buying them in your Australian portfolio at funny weights, and then you're buying them in your French and American and other portfolios because the main line is listed over there. So you're doubling up on the exposure. So it's just some of these rules just don't make any sense to us, and you end up with, and that might be okay overall. You say, like, what's the big deal? Well, 2.5% of your small cap fund in 4 companies that are not Australian and are effectively large cap companies is problematic, right? And overall, if you look at ASX Small Ords, as of end of May this year, nearly 14% of the Small Ords index was in large cap companies. So you're looking for small cap exposure, you're getting 14% of that in large cap exposure, and which large caps on average are lower expected return than small caps. So that's before even you invest $1. Right off the bat, your definition alone has ended up in a funny exposure that you don't want. And then you look at examples like returns differences between MSCI Australia, ASX 100, or Small Ords versus MSCI Small, or S&P 500 versus Russell 1 versus MSCI US. Huge return differences, well above 1-2% a year type of return differences, just because of the index you pick, right? And they're all meant to be, for example, US large cap indices or Australian small cap indices. So there's lots of active decisions being made in these indices, which can result in a very different return experience. And more often than not, it's not very clear why these decisions were made, because a lot of them are not related to expected returns. They're just in somewhat arbitrary rules created by indices, as opposed to our approach where we're very deliberate about saying we want Australian exposure, so these dual listings of foreign companies in Australia don't qualify. We're going to use the size of the company to determine whether it's a small cap or a large cap. But when it comes to weighting, we're going to use a free float adjusted weight because that's what's available to us. There's even differences between weightings available to, for example, to US funds investing in Australian stocks versus Australian funds investing in Australian stocks, because often the limits on how much foreigners can invest in a company. So we even track that difference, right? We'll track that difference, say, when it comes to Qantas, only a certain weight is allowed for the US-based international small cap fund or international large cap fund versus an Australian-based Australian large cap fund, because that's for Australian investors where there's more float available. Lots of detail, lots of nitty-gritty stuff, but we think it makes sense because in the long term, it results in a better exposure, and we think it's a truer representation of what investors are looking for, and overall, it makes the implementation better and a better capture of returns. We don't want 14% of our small cap fund in large caps. That's not what you're looking for when we give you a small cap strategy. So lots of choices like that, but on our end, they're very deliberate and robust and driven to improve investment outcomes. But on the index side, it's often not clear why some of these decisions are being made. And investors, it's very difficult for investors to ascertain all these different rules and different outcomes and impacts because of those rules.
So, the rules and the rigidity of them within the index funds would seem to increase the total cost of ownership for investors and probably increase, at least indirectly, the expense rate. How important is the flexibility not to have to abide by those sort of rules and rigidity?
Yeah, so some of the numbers I said earlier about Australia, they're also applied to US, for example. It's the numbers I said 8 and 2% in US, which is one of the larger markets. If you look at the major indices and the impact of reconstitution effects on those indices, on average, the run up to reconstitution date, 20 days, is about 4% excess returns the wrong way and about 5.7 on the other side reversal. So those are big numbers. So anytime if you're an index fund and you're trading 4 times a year on those dates, those are some of the costs you're paying on your trading. But that's one part of it, right? So that's just pure rigidity built into the index. But then things like, okay, well, every time you do a rebalancing, there's an FX trade associated with that on international indices. How are you doing that FX? Are you also doing that at the end of the day in the closing auction? What are you paying for it, right? Sec lending revenue, a lot of times it's not clear whether the index managers who are tracking indices, they might be giving you a really low expense ratio, but what are they doing with the sec lending revenue? Are they keeping that and therefore making up for the lower expense ratio? Recently, we had an institutional win in US where a large prospect found out that the index manager was keeping a lot bigger chunk of that sec lending revenue for themselves while charging a low fee on the fund, and the client wasn't aware of that. Now, when we look at sec lending revenue, we pay the agent who's doing the work for the sec lending revenue. There's a fair fee you pay them, and everything else goes into the fund. Right? So we don't keep any of it, and we're very clear about that. So there's all these hidden costs. Tax management. If you trade 4 times a year, very difficult to do tax management because you don't have any flexibility on what you trade when you trade it. Meanwhile, we're trading every single day, so we can see what's the better tax outcome between 2 different securities when we're trading them, and we can use the more tax efficient outcome. And if you look at the overall tax efficiency of our funds, it's very good. After tax returns are quite comparable to anybody else out in the marketplace. So, but that's deliberate. That's not just sort of accidental. And on top of that, we have designed our implementation process to be a daily process. So we're looking at these things every single day. I'll give you another example on corporate actions. Often in an index fund, the corporate action selection, so this is something like somebody's paying you a dividend or there's a rights issue. They often take the default choice and that's it, because it's too hard to look at these things every single day. We look at corporate actions across the globe and respond to them on a daily basis. And it could be something as simple as you're receiving a dividend in Europe, and there's 3 different choices, and you could receive the dividend in US dollars, in pounds, or in euros. And depending on which fund it is, those 3 have very different tax consequences, because different withholding tax rates, different tax treaties across the UCITS range versus the US mutual funds versus Australian trusts. We actually take that into account when we make our decision. We look at it and go like, okay, well, for Australian funds, the USD option is the best because it's the most tax efficient, because we have the best tax treaties in that case with US. And UCITS, it might be a different choice. For the US mutual funds, it might be a different choice again. We make different choices where it makes sense, rather than just saying, take the default rate and thank you very much. Right? So there's all these little things which I think in an index scenario, in a rigid index scenario, you leave on the table instead of taking into account and adding value where you can. I'll leave you with the last example. It's a bit dated now, but I still use it. It was the day of the Brexit. When Brexit vote was happening, the expectation was it was going to be a no and everything was going to be fine. And that was the last Friday of June that year. And the vote was unexpected, which caused a lot of volatility in the market. And that was the day all the Russell indices in US had to rebalance. So in a highly volatile day, they went into the closing auction and traded a big chunk of US small cap and US large cap stocks at pretty high rates and left a lot of money on the table. Right? That's the type of rigidity you want to avoid when you're a practical fund manager. You want to have the flexibility. On that day, we stepped back from the markets because our portfolios were well positioned because we had been trading them every single day. So they were pretty close to where they needed to be. There was no rush to trade that day. We can easily step back from the market when all that's calmed down and step back in and use that flexibility to avoid costs.